weekly market insight, where this week there's a lot of pessimism coming out of the investment banks. We're going to go ahead and look at those and kind of understand the rationale and see if we agree with that. I'm Aaron Tuttle, Chief Investment Officer with Gatewood Wealth Solutions, and Chris is joining me, one of our portfolio analysts here at Gatewood Wealth Solutions. Chris, let's just jump right in. Let's start with just the price points on technicals. How's the S&P looking?
We got a decent bounce on Friday, right? Bounced off of 38.5 on the intraday, so closed a little bit higher than that. Decent support around 3,800, but this, we've said it for a few weeks now. Nothing good enough for technicals, for technical traders to want to say, let's get back into this market yet. Still have to look back pretty far for some support. We have had to widen out the chart a little bit to see some of that, but sharp days, right? We're seeing 1.5% days are pretty average right now, whether it's up or down. I think it's likely to continue.
Yeah, so the volatility is to be expected, and as you're saying, I mean, the price of the market is still below the 50-day, 200-day, and I think even the 10-day moving average. Maybe the next couple of days it could pop over, so there's just not much for
that's all sell signals for a technician, right?
Absolutely.
And we're looking on these big pops, so short interest is starting to climb, especially across certain sectors like technology. So when you do get those days where it does start to go the other way, there'll be some short covering buying, and that's why you're seeing those 2.5% day moves in technology.
Yeah, and then there's often people get upset about the short sellers in the market.
Mm-hmm.
You actually want them there during these sharp days for the very thing. It gets you a relief rally, and there's somebody that will actually buy those stocks and close out those positions.
Yeah.
So they're actually helpful whenever it comes to volatility.
Obviously, that was on Friday, that bottom that we put in. Too early to say if we put in a bottom. Next week, we're going to bring on a technician, actually, to talk a little bit more about bottoming and what to expect from VanEck.
I'm looking forward to that. Morgan Stanley is one of the more pessimistic out there as an investment bank. They have the best case scenario at 4450, which is not an all-time high for the S&P 500. Kind of their base case, 3900, around where we are right now, and it could go as low as 3350 for their bear case. So let's jump in and kind of look at that base case. And want to get some comments from you. They're kind of lining it up. They have fire and ice, fire being inflation, ice being a tightening monetary supply. But their base case, they say PEs get back to average, maybe a little bit below, 16.5 on a PE, and then earnings per share growth is 236. So that's about right where we are. What are your comments?
Is that their base, you're saying?
That's base,
okay.
Yes.
Yeah, so to context PEs, right now we're at about 17, right? Around 4,000 on the S&P, and looking at forward earnings, where earnings going to be on that index, it's around 234, 235. So it gets you right around 17, and the long-term average is 16.8. Right. So we're right there. But they're predicting, like you said, a drop in that average, and that the market will actually trade at a discount to long-term multiples.
Right, but whenever you're talking about these PEs and you're trying to forecast, I would say that's well within the margin of error. It's basically the same price, right?
Which is why we like to sometimes do a discounting, right? So look at actual cash flows, because it's really hard to predict what that PE multiple will be. Right. So we want to look back at what were the cash flows from the index and discount those back to today, which I did. I ran through their scenarios. Their bear case at 33.50, it's not that bearish. When you look at earnings, they're calling for moderation in earnings, come back down to mid-single-digit growth, and then a decline in about 10% earnings, getting down to 215 or so, I believe.
Right. I think they're about 212.
212.
Well, it's not about. I have the notes here, so I can actually see they have earnings at 212 and a PE of 15.
Right.
So a little bit below average. A lot of that is because of inflation on input costs as well as labor costs. So the squeeze is not so much as revenue. Remember, they have inflation built in, so revenue would be up. It's that they're having to pass on and absorb so many costs that their earnings are actually coming down. Because remember, the earnings are the revenue minus expenses. So that's really the big push. And then because of inflation, they also would have real interest rates being a little bit higher because of the inflation premium that's put on bonds. So that brings that multiple back down.
So my counter would be their bull case, which I did read through. Like you said, it's only 4,400. They're really talking about moderating growth, right? We've seen 10% growth in earnings. That's really what consensus is. That has not been discounted yet. Analysts are still expecting 9 to 10% growth, and they're saying no, that's not going to happen. And in their bull case, they're moderating it at 5, 6, 7% and saying that's going to continue there. And that's why they're only at 4,400. If you look at what some bulls that have been accurate in the past, like Ed Yardeni, he's done a pretty good job of saying consensus has been too low. He's been the high end, and he's not even close. He's $20 per per share above what Morgan Stanley's saying in his bull
So
case.
he's talking about 260,
Mhm.
right?
So he's talking 260 by the end of 2023, and they're talking about, I think, 240 in 2024. So Yardeni's way ahead of them. And then I also, maybe it's too simple to look at it, but you probability weight these, and you get an index of right around what we're looking at. Because market surveys are predicting 33% chance of recession.
Right. I don't think that's too simple. I think that's exactly what the market is doing. It's pricing in all of these scenarios and trying to say, okay, well, what's the probability? The question is, does somebody actually come up with those probabilities, or did they back the probability out trying to figure it out? And oh, it must be the market's trying to say that there's a 33% chance of a recession.
Because at the beginning of the year, that the recession chances, they were not predicting anywhere close to 33% chance of recession. That's really some of the pessimism that's grown in the last several months.
I think I definitely feel the pessimism, because whenever I'm looking at their bull case, which, as you pointed out, this is not rosy. They're dependent upon supply chains. Okay, so let's say supply chains come back on. Yeah, that definitely would take some inflation. Consumer confidence would rebound. Right now, I feel that pessimism. I'm like, what's going to rebound the consumer confidence? And then consumer goods will come back, and they'll kind of spin those down, as well as China COVID policies going away, which I think actually goes against their inflation call, because yes, you would start to see demand come back on, but the amount of energy pulled into China reopening and the amount of consumer demand that they're going to have, I think that kind of takes away. So I would say that sentiment. Maybe I'm not Yardeni. I'm feeling that pessimism for sure. And I think one of the big reasons is because whenever I look at this money supply and I'm looking at what Fed actions are, we continue to decline. The good news is the slope has changed a little bit. It's still declining, but I want to pay attention here, especially as we come into June 1st, when the Fed begins to reduce their balance sheet, which will actually start to reduce that money supply. So that's the thing that I'm really looking at. Another thing that we said we'd look at are spreads.
Yeah, we're constantly looking at this, but we haven't brought it into a market call in maybe 3 weeks or so. This is the risk that bond investors are demanding for high yield bonds, so risky bonds. So that orange line is the spread above treasuries for high yield bonds, meaning when that goes up higher, they need a higher return, which is they're saying that's extra risk in the market. And we've blown out over the last few months, so we are at year-to-date highs. From a really long historical standpoint, we're still low, but we are increasing credit spreads. It's not a good sign, but it's consistent with stock market being down over the same time period too.
And it's not just Morgan Stanley that's pessimistic. Goldman Sachs came out with a piece. We won't go through the detail, but very similar, about 226 on the earnings, and their multiples are around the same. They're a little concerned as well. And then we had a great talk with BlackRock last week, and they're probably a little bit more optimistic than Goldman and Morgan Stanley, but they see inflation as being persistent in here. They don't see a stagflation where the economy shrinks. They just see this price increases being able to be pushed off, consumer demand going up, income going up, so that inflation will not go back to 2%. It probably has 3% that has some multiples, so they're not making a great big call for a bull market. But I remember for a long time people would say they were cautiously optimistic. I would say that they're still in that camp of cautiously optimistic instead of this kind of pessimistic thing.
Yeah, right. And they were also saying that they think the consumer is relatively strong. We know, at least looking back from the last couple of years, they're not in as good a shape as they were with real disposable income, with inflation eating away. But they think the return to services, not so much spending on durable goods like your expensive stuff, your TVs, couches, that kind of thing. They think a return to services and entertainment is also going to help keep GDP positive.
Yeah, they're really promoting that we haven't fully realized the reopening trade. And there's still a lot of demand and services. And you can definitely see this in travel expenses. If you're trying to book a hotel or an Airbnb, there is not many properties available through the summer, especially if you're near the water, and those prices are certainly high. And so we could definitely see some service spend, especially on those travel expenses. Airline tickets are up as well. Now they are saying that energy remains high as a price. So I think that's what they're saying. That's why there's inflation, but the reopening trade, we haven't fully realized a lot of the efficiencies and gains and pent-up demand that'll come back into the market. They also had another interesting slide, which is just comparing stocks and bonds, because a lot of this pessimism that we're talking about, people are probably asking, well, why are we in the market at all? Why not go to cash or go to more defensive things like bonds? Well, let's look at this quadrant. And if you're in the top right, that's equities and bonds are doing well. And that does happen. It happens probably more often than not that bonds are positive 4, 5, 6% coupon, while equities are up 10, 12, 20% for the year. Then there are also years like 2008 where equities are down substantially, but there's that flight to safety, what I think is what people would expect to happen, and why you would advocate being more conservative, meaning going to more bonds, where you would be in that bottom right quadrant. And then there are years where you'll have equities up and bonds kind of give away. And we saw that in 2021, where the inflation and all that is getting priced into bonds, the interest rates are moving up, but it's still good for equities, especially coming out of 2020. And then we get the years where they both go down. There's not as much of that. It's the bottom left corner. Happened in 2015, happened in 2018. But look at 2022. It's down 10%, and equities are down 10% at the time that they put this slide together. It's since changed. Since then, equities are down a little bit more, and bonds are starting to act a little bit more like bonds over the last couple of weeks. But this is why we've said, don't be defensive. We've been concerned about where the market was going, saying that our prices were too high, but you couldn't just go to fixed income, because you could make an even more bearish case for fixed income, and so far that's been proven correct.
I don't think that, I'm not advocating for equity to fixed income change, but a change in how we're allocating fixed income is really a discussion we've been having the last couple of weeks, because rates have risen so much, and they potentially could bottom here, and you could get even more diversification when if stocks do go into recession mode. We will see a decrease in rates. I don't, unless inflation's here through that recession, but that's really not consensus. I think
one of the bearish calls are that interest rates are high and the economy is going to slow down. Well, if interest rates are high, I think it's 5.5 on mortgages. Yeah. Well, that's a deal compared to where they have been. So maybe it does. Maybe it's time to kind of rethink the way the position is and add some of that exposure, especially if we think a recession is higher and that they would actually hold up.
Right, it's the flight to safety that you talked about. If we're getting 3.25 on bonds on a risk-free treasury, now it's a little bit lower than that. That flight to safety will happen. People will start buying those bonds and push those yields down to 2.5, maybe a little lower.
But I think this chart really helps on why not to go to cash. So the other one is why not to go to bonds in this current environment, or at least heavily into bonds. And this is looking at the best and worst performing days of the S&P 500. And you can go through here and look at March 17th. You can go to March 13th. So in less than a month, it's up 9%. 6%, but let's just start with there. 6, 9, 3, 9, 6, and 7. So well over 20% in a matter of 3 weeks on those up days. If you're out of the market and you're in cash trying to avoid some of the worst days, that's a big move in the market to be out. If you didn't time that well and got out at a higher price than that, and you missed that upswing, you've missed out on a lot of money. I think more money has been lost sitting on the sidelines than money's been lost just waiting it out. But we have pieces like this by BlackRock.
Yeah, this is pretty similar. Looking back to 2002 on the S&P 500, said, what does a $100,000 investment in the S&P look like? And by the close of last year, it was $616,000. But if you had missed the 5 best trading days like you're talking about, you'd have to, we would call this data mining, because it'd be pretty hard to miss those 5 days, but this fits the narrative. So you miss out on 44% of your gain. So it's significant, and it's not going to happen to a long-term investor, but a trader certainly. Look at last week.
I think it would happen to Brian McGee.
A trader could easily have sold last Thursday, see the rip up on Friday, and then got back in at the highs. So.
Right, absolutely. But this is only one side of the story, right? So many of the wholesalers present this to advisors. Advisors will then present it to the clients, and it's a good story. It's a good reminder. But what would happen if you missed the 20 worst days? Because isn't that the other side of that? Well, this slide, the 20 worst days would be green, and then the 20 best days, missing those days, would be red. And then you have a purple line, which is really you miss both best and worst. And then you have a buy and hold, which is also that blue line. And that blue and the purple are basically there. Well, it tells me one thing, a couple of things. One is that the best and worst days, there's not like best days are up substantially or worst days are worse than best days. they're basically the same. The volatility is on the downside and the upside. Another thing that it says is you got to be really careful about trying to time it, because yeah, you want that green line. You want to miss those worst days. They're often followed by the best days, so timing is going to be really hard. But if you're in that blue, or you're in that the purple, or you're in the green, your retirement's fine. But if you're in that red, you're not. So that's a risk that you're taking by being out of the market. Once again, more money has been lost sitting on the sidelines than what has been just left in the market. So you want to be very cautious about doing that and really consider what you're doing, because a lot of times when you want to get out of the market and you want to go to cash, a lot of the downside has already been realized. And then that means a lot of that upside is coming. And once again, remember, those up days are 9-10%, and they are back to back. All of a sudden you've missed most of the rise. So it's really, you really have to be cautious whenever you're thinking about going to cash, and we have been. That's one of the reasons that we've just sought to just take out some of the edge. Now, where we spent, if we've taken off the edge and we've gained against our benchmark the last quarter, we definitely felt that edge coming into the end of 2021 and into the beginning of 2022, while we're in very heavy growth stocks that have really felt it. The NASDAQ is certainly in the bear market. S&P has not been. So we're not seeking cash at the moment, looking at that money supply to see, but more just trying to manage the risk of the portfolio, considering, at least I don't believe that we've seen the bottom of this market. Hopefully we're close. Monetary policy is going to be a big indicator on whether there's more to come, or if we're finally stabilizing here for a new bull market. Just don't know when. Any other comments that you want to make?
No.
All right. Well, we appreciate you tuning in. If you haven't subscribed yet, hit that subscribe button. And if you like Chris without a tie, make sure you hit that like button. We really appreciate you tuning in, and feel free to hit that arrow and share with your friends. Thank you, and we'll see you next week. Next week we have Vanek on
yes.
to talk technicals. So looking forward to that call. And then I believe we're going to have 1 week where we're out. Is it June 7th that we're not going to be doing the call? Chris,
June 8th.
He thinks he gets vacation here, so we're going to let him go ahead and take that day. All right, well, appreciate it, and see you next week. Thank you for watching. Be sure to like the video and press the subscribe button right here so you never miss an update. If you have any questions or would like to get in touch with an advisor, click the link in the description below to request a meeting. We'll see you next time.